So let me share my screen with you. Oh, so much. Okay. Okay. So the good thing about risk and uncertainty that we are going to be starting is the fact that for those of you that did a skills level performance management, you have been taught on risk and uncertainty is the same thing, except that the question may be different in a more advanced ways. However, um, I will do my best to ensure that we we stay within the 2 periods for us to be able to complete risk and uncertainty so that we can have about 2 or 3 periods for business valuation. So there is tendency that the class may extend to first week in November, the first Tuesday in the month of November. All right. Remember, I missed a class due to network glitches. All right. So let's talk about risk and uncertainty. Businesses operate in an environment that involve the element of both risk and uncertainty. This is because the cash flow estimates, including the market demand, the sales revenue, or cash and receipts, are basically is based on projection, and which may be different from the actual results or performance due to prevailing economic and market condition. Therefore, it is important for a company to incorporate risk and uncertainty in the variability that evolved in the cash flows, so that in order not to be overly optimistic, when a company wants to prepare a budget, they would have accounted for, they would have used their past experience. Say, for example, oh, okay, in 2023, we made sales of 500 million naira. Therefore, as we are moving to 2024, during our budget activity, so let's take 20% on top of what we achieved in 2023. So you are making a projection on the basis of your past experience. When you now get to the full year of that 2024, it is possible that the actual results may be different from what you anticipated to achieve. If the actual result is better, much more higher than what you projected to achieve, that's a plus. But we are looking at a situation whereby the actual may be lower than what was planned initially, so which represents a risk. So in order to avoid being overly optimistic, okay, so let's incorporate element of risk. You could remember what happened in 2020 during the COVID-19. Nobody saw it coming, and it affected everybody, every individual, every company around the world. All right. So that is a risk. All right. So generally in finance, risk and uncertainty are used interchangeably. Therefore, what do you understand by risk? We have discussed some of this during our lecture when we had the portfolio theory. So risk is a chance that the actual results may be different from the expected results. It is a possibility that some or the entire original investments may be eroded, may be lost. Okay? So risk arises where the future outcome is unknown, but it can be determined by using past experience and probability of occurrence. So when you are using past experience to predict the future outcome, that is a risk. You know You don't know the future outcome, but to a large extent, you can predict what tomorrow holds using your past experience and then the probability of occurrence. That's what I was saying the other time, because that a company makes sales of 500 million naira last year. Now they want to prepare the budget for the coming year. So you are using the past experience to project for the future. That is a risk. Okay? Then, but uncertainty occurs where future outcome is unknown and then no probability of occurrence or past experience that can be used to project the future outcome. Okay, so that is the difference between the two. Now, what are the methods of project evaluation under risk and uncertainty? There are about 14 or 15 of them, but our focus will be on about 5 of all those methods. Okay, so we are going to do our expected value. We use expected value method. We are going to talk about standard deviation and coefficient of variation. We talk about probabilistic simulation. We talk about sensitivity analysis and then the decision tree. So those are the 5 elements that we are going to discuss in our class. Of course, we have done already capital asset pricing model. So we have talked about the payback period during our capital budgeting decision. Of course, uh, I don't want to go into that. All of this, they are just elementary. The risk-adjusted method or risk premium is a very straightforward method of adjusting for risk, okay? Just compute your NPV. So instead of you to use the normal cost of capital given, then you are going to add, in addition to the cost of capital, you had a risk premium, okay? So for example, if your cost of capital is 10% and you are given a risk premium of 5%, so you add the two together, that will be 15%. So instead of you to appraise the project using the cost of capital of 10%, rather you are going to use cost of capital of 15 that include the risk premium. So all those ones are very straightforward. I don't want to go into it. So our focus is on the 5 elements that I've indicated previously. So let's start with expected value method. Expected value method. What do you understand by expected value method? The expected value method is also known as mathematical expectation. It involves averaging the various possible outcomes. Okay, it involves averaging the various possible outcomes. Therefore, the expected value is computed by multiplying the probability of occurrence at each state of nature. You multiply with the possible outcome, that is the cash flows or returns. Generally, expected value methods are mostly preferred by the risk neutral investor, okay? Because as a risk neutral individual, um, the investor do not seek or avoid risk, and we always accept any outcome under any condition, okay? So as far as expected value method is concerned, it's a very straightforward. All you need to do is to multiply probability of occurrence with the possible outcome. That is, multiply probability with the cash flows, and you find the average. However, it is possible that in a particular question, you may not be given the probability. So, but one thing you need to understand is that the probability is usually attached to state of nature. State of nature is the event in the economy. You know, in the economy, you can have good, bad, worse. You can have boom. You can have recession. You can have success. You can have a failure. So there could be optimistic, most likely, or pessimistic. You can have high, medium, low. When you have such a thing, in a scenario, you should know that those are states of nature. All right. That's the state of nature. And then if probability is not given to you and you are given the number associated to each state of nature, so you need to use that number to form your probability. So please, once again, I'm repeating it. probabilities are usually attached to states of nature. Now, how do you compute your expected value? Like I said, just multiply the probability of occurrence with the possible outcomes. The possible outcome represent the cash flows or return. Okay, so that is that. Then how do you compute standard? So how do you compute expected net present value? Expected net present value will be computed the same way you normally compute your net present value, except that we are supposed to calculate expected value first using this formula. You calculate expected value. So it is that your expected value you are going to use to compute your NPV. That's all. Because what this is saying is that you want to adjust for risk before you begin to determine the financial viability of the project. So when you are given a cash flow, instead of you to use your normal cash flow to compute your NPV, no, you need to first of all adjust for risk. Okay, so you are going to be given the probability. So just multiply the probability with the cash flows. So your expected value is your adjusted cash flow. So that adjusted cash flow is what you are going to use to compute the NPV. The result is what is known as expected net present value. However, as far as expected value is concerned, where two or more alternatives are being considered, okay, any option with the highest any option with the highest expected value should be selected. Okay, that's that. Then before we move to standard deviation, let's have an illustration. Let's have an illustration. Before that, let me know if you have any question for me so that I can quickly attend to that before the illustration. If not, just let's go straight. So illustration on expected value. Yes, I need somebody to read for us, please. Yep. Who will help us to read? Thank you, Jacob.
Lewandowski PLC, a manufacturing company located in the eastern part of the country, designs and manufactures personal stress monitoring device, that's PSMD. The device has a commercial life of 3 years. As a result of wide advertisement campaign, the company recorded high sales for the 2 years, while the sales figure for the third year went down substantially due to low demand for the product. The marketing department of the company was assigned the responsibility of finding out the reason for the low demand. The department discovered that the consumers complained of the low quality of the product, which makes it much less durable. With this information, the company decided to submit 200 samples of the devices to the quality and assurance department of the company for analysis. Out of the 200 devices submitted, 50 enjoyed an above average demand, 120 enjoyed average demand, and the remaining 30 enjoyed below average demand. This demand pattern is applicable in all the company's products. Recently, the company developed a new device known as Simple and paid 10 million as development costs. The following projections were made in respect of the product Simple. So variable costs will amount to 30% of sales. Sales revenue and variable costs will be received and paid respectively on the last day of the year in which they arise. If Simple is produced, a special machine will have to be purchased at the beginning of year one at a cost of 190 million, payable at the time of purchase. The machine will have a scrap value of 10 million naira at the end of the product's life. The amount is receivable 1 year after the last year in which production takes place. If purchased, the machine will be installed in an unused part of one of Lewandowski's PLC's factories. The company has been trying to let this unused factory space at a rent of 16 million per annum. Although there seems to be no chance of letting the space in year one, there is a 60% chance of letting it for 2 years at the beginning of year two, and a 50% chance of letting it for 1 year at the beginning of year three, provided it has not been let at the beginning of year two. All rental income will be received annually in advance. So fixed costs, which includes depreciation of the special machine on a straight line basis, are expected to amount to 70 million per annum. These costs, which are all specific to the production of simple, and with the exception of depreciation, will be paid on the last day of the year in which the advertising expenses will be paid on the last day of the year in which the advertising expenses will be paid on the first day of each year and will amount to 30 million naira at the start of year one, 20 million naira at the start of year two, and 10 million naira at the start of year three. The Waduski PLC has a cost capital of 20%. You are required to analyze and evaluate the production of simple based on expected present value.
All right. Thank you very much, Jacob. Yes, that is the question. From the requirements, you are told to analyze and evaluate the production of simple based on the expected present value. So you want to calculate expected net present value. What are you supposed to do? All right. This question could have been very straightforward, but only that examiner has put some um, trap. There are some traps that have been set in the question that if care is not taken, if you are unable to deduce, if you are unable to interpret the information given, you may likely get it wrong. Two things examiner has put in the question that required you to think outside the box. Now, from the requirements, we are to calculate the expected net present value. We want to calculate expected net present value. Ordinarily, what we are supposed to do is to multiply probability uh, of occurrence with the possible outcomes. But in this question, we only have possible outcomes because examiner has given to us that the sales revenue for the respective years are given to us under the various states of nature, but we are not given probability of occurrence. So first thing first that you need to do is to determine probability because these are the sales value given in the question for the respective years. And this sales value is not direct because the examiner has told us there are some conditions um, attached to the sales revenue. Therefore, we need to first of all go ahead and calculate our probability. Once we have that ready, then we calculate expected value, expected sales revenue. Once you get the expected sales revenue, we go back to the question again, whether we have variable cost. Yes, there's a variable cost of 30%. So if variable costs, we are told that variable cost will amount to 30% of sales. And so if that is the case, then instead of me to be doing sales value, expected sales value, then variable cost. So instead of me to be doing that, all I need to do, once I get my sales, I will just say 70% of that as my contribution. So that will save time. All right, so without wasting more time, let me stop sharing this and move to the working note. Okay, so the first page will be for the main solution. Then the workings will follow thereafter. So let me say working. Working number one. In the question, we don't have probability. So the first thing, because our examiner has asked me to calculate expected net present value, and I don't have probability. How will I be able to do that? So I have to think outside the box. In the question, I've seen state of nature. The state of nature is above average, average, and then below average. So once I have that, then I need to use that one to get my probability. So I will say probability. Okay, let me do it this way. Okay, calculating probability. Okay, let me help you. The probability will be computed using the state of nature relating to market demand. Since the probability is not given. Okay, this is shown as follows. Okay, so I have the state of nature, state, then demand, probability. Okay, so we have the first state is above average demand. We have average demand, then below average demand. Those are the three states of nature. And then according to the question, let's go back to the question. So let's go straight to where we have in the third paragraph. In the third paragraph, we are told that with this information, the company decides to submit. The company decides to submit 200 samples of the devices to the quality and assurance department of the company for analysis. Out of the 200 devices submitted, 50 enjoyed above average demand, 120 enjoyed average demand, and the remaining 30 enjoyed below average demand. Therefore, I would then say the demand for the probability, this will then be equal to 30. Let me make this one as a working. Okay, so 30, the first demand, the above average demand is 50 divided by the total sample of 200. Okay, the second one is 120 enjoyed average demand out of the entire sample of 120 of 200. Then the balance of 30 enjoyed below average demand. So what do you get? 50 divided by 200. So 50 divided by 200, that's 0.25. 120 divided by 200, 60%. Then the balance will be 15%, 0.15. Please, at all time, your probability must be equal to 1. At all time, your probability must be equal to 1. So if your probability is not equal to 1, you have to make it equal to 1. Because if your probability is not equal to 1, there is no way you can have optimal solution. Okay, please note that. Okay, this is 1. Now that I have the probability, I need to then go ahead and calculate the expected value. Working number 2 now. I want to calculate expected sales. Expected sales revenue. Okay. How do you calculate expected sales revenue? Remember I said, to get the expected value, what are you supposed to do? Just multiply probability with the possible outcomes. Therefore, expected sales denoted as X bar. Therefore, expected value is equal to probability summation of probability multiplied by X bar multiplied by the cash flow. Okay, so there are three, this project has 3 years. Okay, so to do this, I will create a column for probability. First thing first, I will say year 1, year 2, then year 3. Okay, so under each year, I'm going to have column for cash flow, then column for expected value. Cash flow, expected value. Cash flow, and then expected value. Okay, then I will have column for the probability. Here will be for probability. Okay, my cash flow is X. Therefore, the probability is 0.15, sorry, 0.25, 0.60, then 0.15. Okay, okay. So let me do that. Okay, so I have to divide each of them into 2. Okay, so total. This will then represent my expected value, expected sales revenue, expected sales revenue. So I will go back to the question. What's the cash flow? The sales revenue for the first probability under above average, 240. Under above average, 240, 500 and 160. 240, 500, but it's not 200, 240. 500, then 160. Average demand, 140, 340, 80. 140, 340, 80. Then below average, 50, 180, 50. 50, 180, then 50. So to now get the expected value, you are supposed to multiply probability with the cash flow. Therefore, 0.25 multiplied by 240 equals 60. 0.6 multiplied by 140 equals 84. 0.15 multiplied by 50 equals 7.5. When you add it up, that will give us plus 144. That's 151.5. So the total expected value for year one is 151.5 million. For year two, probability of 0.25 multiplied by cash flow of 500 million, 125. 0.6 multiplied by 340 million, 204. 0.15 multiplied by 180, 27. So 27 plus 329, 356. The third year, 0.25 multiplied by 160, 40. 0.6 multiplied by 80, 48. 0.15 multiplied by 50, that's 7.5. Add it up, that's 47.5. Sorry, 88.
95.5.
Okay, thank you. 95.5. So now that I have the expected sales, all I need to do is to go ahead and compute my NPV, my expected net present value. Okay, using the expected value computed. However, according to the question, examiner told us that variable cost is 30% of sales. So instead of me to use 30% of sales to get my variable cost, I don't need that. I can just use my contribution. Contribution is different between sales and variable cost. So I'll just multiply, if variable cost is 30%, that means contribution will be 70%. So in that case, I need to go and compute my expected NPV. The name of the company is Lewandowski PLC. Okay, solution to illustration. What is that? Illustration one. Okay, solution to illustration one. Lewandowski PLC. So calculating expected net present value. Figures are in million. Okay. So examiner has told us in the question that the useful life of the project is 3 years. Therefore, we'll create a column for year 0, year 1, year 2, and then year 3. I will leave a space in case there's any extension. Then I'll also create a column for, in this question, we don't have anything like tax, so I don't need to worry myself about tax. All right? So, however, we are told in the question that when Jacob was reading it, we are told that there is a, we are told in the question that the machine will have a scrap value of 10 million naira at the end of the product's life. The amount is receivable 1 year after the last year in which production takes place. So the useful life of this project is 3 years. Ordinarily, after the project has been completed, we are told that there will be a scrap value of 10 million naira, and that 10 million naira will not be received until 1 year after. So that will take us to the fourth year. So we need to increase the number of years to 4 because of scrap value. Then we can have additional column for workings. Okay. So the first item here will be contribution. So I don't need, ordinarily, I'm supposed to come in and say sales value. I'm supposed to say sales. Then whatever I've calculated as my sales, I will put it here. Then the next item will be variable cost. Variable cost, which is 30% of sales. I will put it, it's a waste of time. Since I know that sales minus variable cost will give me contribution. So I will just say contribution at 70% of sales. Okay? Contribution is 70% of sales. Therefore, the sales for the first year is 151.5 multiplied by 0.7. That's 106.05. 106.05. Okay? Let me go down there and put the number so that you know how we got the numbers. Note. Contribution is 70% of the expected sales. Revenue. Okay. Because if sales is 100%, we are told that variable cost is 30%, then contribution will be 70%. So that's how we got our contribution in case when you are your own. All right. Again, 356 multiplied by 0.7 for year 2. That's 249.2. 249.2. Then the third year, 95.5 multiplied by 0.7 equal 66.85. 66.85. Nothing goes to year 4. Okay? All right then. So you can say, sorry. Then after this, we go back to the question, what are the other cash flows? What are the other relevant cash flows that we need to consider? So from the first, second, third paragraph, there's nothing like cash flow there. But when you go to paragraph number 4, you are told that recently the company developed a new device known as Simple and paid 10 million naira as development cost. Development cost is a sunk cost and therefore irrelevant. You ignore it. It's not a relevant cash flow. It's a past cost. All right, move on to the next paragraph. So we have treated the next paragraph, which talk about variable costs. Okay, then the next one, we are told that if Simple is produced, a special machine will have to be purchased at the beginning of year 1 at a cost of 190 million. That 190 million naira represents the initial outlay payable at the time of purchase. The machine will have a scrap value of 10 million naira at the end of the product's life. The amount is receivable 1 year after the last year in which production takes place. Okay, that's a scrap value. We'll treat that one later on. If purchased, the machine will be installed in an unused part of one of Lewandowski's PLC factories. The company has been trying to let this unused factory space at a rent of 60 million naira per annum. Okay, so although there seems to be no chance of letting the space in year 1, there's a 60% chance of letting it for 2 years at the beginning of year 2, and a 50% chance of letting it for 1 year at the beginning of year 3, provided it has not been let at the beginning of year 2. All rental income will be received annually in advance. So what do we do? Examiner has given us information on, on rental income, on rental income, which of course is relevant. The 60 million is relevant, but how do we treat it? Examiner has given us a chance. Chance is the same thing as probability. So we are told that there is an unused factory space that worth 16 million naira, and the company has been trying to let it out, but nobody is forthcoming. However, we're now told that there seems to be no chance of letting it in year one. There is a 60% chance of letting it for 2 years at the beginning of year two. Beginning of year two is end of year one, because before you can recognize a year, you could have counted 12 months. So if you say beginning of year two, say January is not up to 12 months. Therefore, beginning of year two represents year one, end of year one. Beginning of year three represents end of year two. Beginning of year four represents end of year three. Okay, I believe that is clear. So examiner is now telling you here that there is a 60% chance of letting it for 2 years at the beginning of year two. So at the beginning of year two, you have a 50% chance, 60% chance of letting it for 2 years in advance. Therefore, you are supposed to take 60% of the range of 16 million, okay, which is 9.6 for the next 2 years, year one and then year two. So let's quickly go and do working for that. Let's do working for our the opportunity cost. That's working number 3. Opportunity cost on rent. Okay, so create a column for year one, year two, then year three. Okay, then I will have workings here. Then I will have probability here. Okay, so what are we? Examiner has told us that there's a 60% chance of letting it for 2 years in advance at the beginning of year two. So 60%, 0.6, that's a 60% probability of letting it for 2 years at the beginning of year two. Like I said, beginning of year two is end of year one. So you are paying the rental income for 2 years in advance. Therefore, I would then say 60% multiplied by 16 million naira. So that will give us 9.6 for 2 years in advance. Okay, so that's the treatments for the first probability. Okay, now the next one, you're now told further that and a 50% chance of letting it for 1 year at the beginning of year three, provided it has not been let at the beginning of year two. 50% chance of letting it for 1 year at the beginning of year three. Beginning of year three is end of year two. So you want to let out 50% at the beginning of year three. Remember, probability must always be equal to 1. If you have let out 60% of the range of 16 million, that means you are left with 40%. But examiner did not tell you 40%, you are now told 50%. So is it 50% you are going to account 50% of the 60 million? No. It has to be 50% of the balance of 40%. Okay? Because examiner did not tell you 40%, but it is implied because you've already let out 60%, you are left with 40%. Therefore, I need to account for 50% of the balance of 40%. So this will then be equal to 50% multiplied by balance of 40% multiplied by the rent of 16 million. Okay? So 50% of the 40% will give me probability of 0.2. Okay. Then what do you have there? Remember, it's at the beginning of year 3. Beginning of year 3 means end of year 2. Therefore, I would then say 0.5 multiplied by zero point 0.4 multiplied by 16. That's 3.2 in year 2. Okay. So we have a balance. That's all. But our probability is not equal to 1 yet. Remember, out of the balance of 40% of the probability, we have taken 50% of the 40%. So you need to balance the 50% of the 40%. I would then say 0.5 multiplied by 0.4. That will give me probability of 0.2. So at the end of the day, I've balanced up my probability. Okay. So here is 1. All right. And then this one, let me complete my table. All right. So here is 9.6. Here is 12.8 dash. That's how to calculate the opportunity cost on rent. So I will then go up there. Opportunity cost dash. For year 1, 9.6. That's the cash outflow. Because the company is losing it. 12.8. The company will not be able to receive the rent due to the project. So next item, still on the same paragraph, we're now told that, we told further that fixed costs, which include depreciation of the special machine on a straight line basis, are expected to amount to 70 million per annum. So we have been given a fixed cost that included depreciation. Remember, when we had capital budgeting, I explained to you that there are 3 different ways examiner can test you on fixed cost. Number 1, if you are given a fixed cost, no additional information, that fixed cost is irrelevant, except it will change. Provided the fixed cost is not increasing, it's not changing, then of course, it's not relevant. So if you are given a fixed cost, including depreciation, like in this case, that fixed cost is not relevant, but you need to go ahead and calculate the annual depreciation and less from the fixed cost. The balance or the difference is relevant. The third way fixed cost can be treated is if you are given a fixed cost excluding depreciation. The fixed cost that exclude depreciation is relevant. You have to account for it. So, but in this particular one, you are told that the 70 million naira include depreciation. So we need to go and calculate annual depreciation and find the difference. So working number next. So working number 4 now. Specific fixed cost. So under this, we have been told that, of course, we are given a fixed cost of 70 million naira. Out of this fixed cost, we are told that it includes depreciation. We don't know the amount of the depreciation, so you need to less. So I will less annual depreciation. And you know depreciation is the cost minus scrap value divided by the useful life of the projects. Okay, which is equal to the cost of the project is 190 million. Scrap value is 10 million. Useful life is 3 years. Therefore, what do you have there? So 180 divided by 3, that will give us 60 million. So annual depreciation is 60 million. So 60 minus 70 will give us 10 million. So that 10 million naira is the relevant fixed cost we are supposed to account for. An examiner has told us that this fixed cost is specific to the project. Okay, so every year is the same amount, 10 million. So let's go and indicate that. So specific fixed cost, 10 million, 10 million, 10 million. Working number 4. Next item, let's go back to the question. The costs which are all specific to the production of simple and with exception of depreciation will be paid in the last, so we are done with that. So advertising expenses will be paid on the first day of each year. First day of each year means at the beginning of the year. And we amount to 30 million naira at the start of year 1. Beginning of year 1 means year 0. Beginning of year 2 means year 1. Beginning of year 3 means year 2. So we have 30, 20, then 10. Advertising expenses, adverts. So 30 at the beginning of year 1, 20 at the beginning of year 2, 10 at the beginning of year 3. Okay? Next item. Lewandowski PLC cost of capital of 20 is 20%. So that's all. That's all. I don't think there's any other cash flow we need to indicate apart from the scrap value. So we have a scrap value of 10 million. We are now told that this 10 million naira will not be received until 1 year after. So and that's why we extended to year 4. Here is 10 million. Then we also have the initial outlay, which is 190 million in year 0. So there's no working capital, no taxation. So that's why we did not calculate capital allowance. So here will then be equal to the net cash flow, 220 for year 0. So give me the net cash flow for each year. Are you there?
Yes, sir.
106.05 minus 19.6, 36.6, 39.6, 66.45.
216.4.
Okay. 216.4. All right then. So now that we have the net cash flow, let's determine the present value. Examiner has told us in the question that cost of capital is 20%. At 20%, somebody should give me annuity factor, sorry, discount factor of year 1 at 20%. Yep. 1.2 raised to power 1 minus 0.833. I don't know. I don't want to be complaining about this class again. That's the way you have started from day 1. 1.2. Let me just do my work. 1.2 raised to power 2 minus 0.694, 1.2 raised to power 3 minus 0.579, 1.2 raised to power 4 minus 0.482. Okay, so now that I have the discount factor, I can then get my present value. Here will be 220. Present value in brackets for year 0, then 66.45 multiplied by 0.833, 55.35. Okay, 216.4 multiplied by 0.694, 150.18.
Yeah, 4.82.
4.82.
32.92.
32.92. All right. So let's get the expected NPV. So the expected net present value will then be equal to 4.82 plus 32.92 plus 150.18 plus 55.35 minus 220 equal 23.27.
23.27.
23.27 positive. So examiner is asking us to analyze and evaluate the production of simple based on the expected present value. Show all relevant calculation. That's end of the question. So that's end of the question. Of course, if examiner is asking us whether the project should be accepted, yes, it should be accepted considering the positive expected NPV of 23.3 million. Okay. So I can just say the project or the production of simple Lewandowski PLC should consider the production of simple. Okay. Since it is financially viable. Okay. As shown by the positive expected net present value of 23.3 million naira. So that's it. So you need to state your assumptions. Even though examiner did not ask you for any assumptions, you have to state your assumptions. You can talk about in the assumptions for you to be able to earn your full mark. You need to state your assumption. This is 30 marks question. So you talk about cash flows. I've already said it previously. Anytime you want to state your assumption, you must talk about cash flows. What's your assumption on cash flows? It is assumed that all the cash flow estimates are realistic and will occur at the end of each year. That's that. Then we also have sunk costs. Okay, we have sunk costs. Under the sunk costs, you talk about the development cost of, is it 10 million naira? How much is that development cost? We are given in the question. Where is it again? Yes, 10 million naira. So you can state that the development cost of 10 million naira is irrelevant because it's a sunk cost, and therefore this has been ignored. That's it. Then you can also talk about depreciation. Okay. Number three, you can talk about depreciation. What's the assumption on depreciation? We state that depreciation is a non-cash item and therefore irrelevant. The depreciation included in the specific fixed cost of 90 million naira has been deducted. All right, so that's that. Then number four, if you like, you can talk about cost of capital. Okay, so what's your assumption on cost of capital? It is assumed that the cost of capital of 20% is appropriate and consistent with the risk, and consistent with the cash flow and the project risk. That's all. So these are some of the assumptions we have made in the question. If there are other ones, so just include it there. Okay? So that's that. Let me stop sharing this and move to the working note. We are going to standard deviation and coefficient of variation. So do you have any question on this illustration that we just solved before I switch?
No, sir.
All right then, so let's move on. All right, so let's talk about standard deviation. What do you understand by standard deviation? Standard deviation represents a statistical measure of absolute dispersion and is a measure of spread about mean value. Standard deviation is used to measure the risk inherent in a project. Where two or more projects are being considered, any project with a lower standard deviation should be undertaken or should be accepted. Therefore, how do you compute standard deviation? There are three different formulas that you can use to compute standard deviation depending on the nature of the cash flow. If you're asked to compute standard deviation, just ordinary standard deviation, then of course supposed to be standard deviation is the square root of variance. Okay? Is the square root of variance. However, it is possible you may be asked to compute standard deviation of the expected net present value. So you have to watch out. Anytime an examiner asks you to calculate expected net present value and you have to calculate standard deviation, you should know that you are going to calculate standard deviation of the expected NPV. Therefore, how do you compute standard deviation of the expected NPV? The standard deviation of NPV can be computed depending on the nature of the cash flows. So if you are given a mutually dependent cash flow, then standard deviation will be computed as the standard deviation multiplied by annuity factor. Okay? Standard deviation multiplied by annuity factor. So in this case, because my cash flow are mutually dependent, then I need to go and calculate my standard deviation, which is calculated as square root of summation of probability of x minus x bar square. So I'll first of all go and calculate standard deviation using this formula. Once I have that done, then I need to come and calculate the standard deviation of the expected net present value, which is equal to the standard deviation computed multiplied by annuity factor. Okay, and you know that annuity factor annuity factor is computed as 1 minus 1 plus r raised to power minus n all divided by r. Okay, so that is how you are going to calculate standard deviation of NPV, where cash flows are mutually dependent. What do you mean by mutually dependent cash flow? The mutually dependent cash flows are cash flows in which the events in each year are the same. So if the events in the market or in the economy affects all the cash flows for the relevant years, then it means that the same events affect all the relevant cash flow. It means that they are mutually dependent. Okay. So if the cash flows are mutually dependent, then this is how to compute the standard deviation of NPV. Then the second one is where you have independent cash flows. What do you mean by independent cash flows? Independent cash flows are standalone cash flows in which the events in each year are different. Okay? So once you are given different cash flows for each year, it means that they are independent cash flow. So if you are given independent cash flow, then standard deviation of NPV will be computed as the variance of each year divided by 1 plus r raised to power 2t. So this is the formula that you are supposed to use to compute standard deviation of NPV, where cash flows are independent. Okay? Now, that is as per standard deviation. So any of those three methods, any of those three formulas can be used to compute standard deviation. This, and then the third one here. Any of these three can be used to compute standard deviation. Then finally, let's talk about coefficient of variation. Then thereafter, we are going to have two illustrations to demonstrate it. Now, what do you understand by coefficient of variation? The coefficient of variation is a statistical measure of relative dispersion and is a measure of spread about mean value. The coefficient of variation is used to measure the riskiness of a project, and the higher the coefficient of variation, the riskier or the more risky is the project. So again, where two or more projects are being considered, any project with a lower CV, coefficient of variation, will be selected. However, in a situation whereby different projects with different sizes are being considered, then standard deviation may not be suitable because it will not produce optimal solution. Hence, under such a circumstance, a more relative measure of dispersion, that is, coefficient of variation, should be used. Okay, therefore, how do you compute coefficient of variation? The coefficient of variation will be computed depending on the standard deviation computed, because coefficient of variation is a function of standard deviation and then the expected value. So if you are asked to calculate standard deviation, ordinary standard deviation, like in this case, okay, um, square root of summation of probability of x minus x bar square. So whenever you have calculated standard deviation using this formula, and you are now asked to calculate coefficient of variation, then the formula to use will be this one. Okay, that's the formula to use. But if you are asked to calculate standard deviation of NPV, then you are now asked to compute coefficient of variation. In that case, you are supposed to use this other formula. So those are the two formulas that you can use to compute coefficient of variation. Okay, so that's that. Now, let's move on. Sorry. Okay. So at this stage, let's have illustration. Let's have illustration. I'll be very happy if we can do sensitivity analysis today. so that in our next class, we do probabilistic simulation and then decision tree. Okay? All right then, so let's have illustration. Let's have illustration that has to do with standard deviation, expected value, coefficient of variation. Okay, somebody should read illustration number 5 for me. Illustration 5.
Component
Component
limit.
limited. Okay, go on.
I need to check.
Go ahead, Debbie.
Okay. Component limited is considering whether to invest in a project which would entail immediate capital expenditure on equipment worth 40,000 naira. The expected sales volume from the project are given below. The unit selling price is 15 naira. Variable cost per unit is 9 naira. Once sales are established at a certain volume in the first year, they will continue at that same volume in the subsequent years. The useful life of the project is 6 years, and the equipment would be sold for 5,000 naira after the end of the project. The company's cost of capital is 10%. You are required to calculate one, the expected net present value of the project, two, the standard deviation of NPV, three, the coefficient of variation.
Thank you very much, Debbie. That is the question. In these requirements, you are to calculate the expected net present value of the projects, the standard deviation of the NPV, and then the coefficient of variation. This is very straightforward. But one thing is very clear. You are going to struggle. As small as the question, you are going to struggle if you don't know what to do. In this question, remember, the first requirement is to calculate expected NPV, meaning that you need to first of all compute expected value. Once you have the expected value, you then go ahead and compute the NPV. But in this particular question, ordinarily, I'm supposed to multiply probability with the cash flows, but I'm not given cash flows. What am I supposed to do? First thing first you need to do is to go and calculate your cash flow. How do I determine my cash flow? In this question, I've been given selling price to be 15 naira, variable cost to be 9 naira. So since I have selling price and variable cost, I need to go ahead and calculate contribution. My contribution will then be equal to 6 naira. Once I have the contribution of 6 naira, I need to calculate total contribution at each state of nature. How do I get my total contribution? My contribution per unit multiplied by the sales volume in units. So that will give me my total, that will give me my cash flow. Once I have my cash flow, I need to compute expected cash flow. How do I get my expected cash flow? I already have the probability, then probability multiplied by the contribution will give me expected value. Once I have the expected value, I need to go ahead and calculate the expected NPV. That is what you need to do. That's what you need to do. Therefore, let me stop sharing this and move to the working notes quickly. Okay. Solution to illustration number 5. Solution to illustration 5. The name of the company is Tompolo Limited. So we asked to calculate the expected NPV. So I will use this one. Requirement number 1, is it 1 or 8? Yes, 1. Requirement number 1. So calculating expected net present value. Okay, create a column for year, description of item, cash flow, discount factor. The cost of capital given in the question is 10%. The present value. Year 0, the initial outlay. According to the question, the initial outlay is 40,000 naira. Okay, here will be 40,000 multiplied by 1, 40,000. So I will then go back to this question. What's the useful life? Examiner has told us that the useful life of the project is 6 years. Okay, so the useful life of the project is 6 years. Therefore, but first thing first, I need to determine my cash flow. So let's go and do working for cash flow. This second page will be for standard deviation and coefficient of variation. So let's do our workings here. So working number 1, I want to calculate my cash flows. Since I have selling price and variable cost, then I need to calculate contribution. So calculating contribution. Contribution equal to selling price minus variable cost per unit. So selling price is 15 naira. Variable cost is 9 naira. Then contribution per unit is 6 naira. Now that I have the contribution per unit, I need to determine total contribution. So I create a column for units, contribution per unit, then total contribution. So the first unit is 2018, 2000, 18, 15,
15,
25,
1,000.
then 1000 units. Contribution per unit is 6 naira. So 6 multiplied by 2000 will give us 12,000, 10, 8, 9,000, 15,000, then 6,000. So now that I have the total contribution, then I can then proceed to go and compute my expected value. So my expected value, let me use this space. So number 2 requirements, according to the question, you have to compute the standard deviation. So I need to calculate variance first before I can get the standard deviation. So I will then say, let me use number 2, calculating standard, calculating expected value, variance, and standard deviation. Okay. So examiner has told us in the question that once sales volume is established at a certain level, they will continue at that level subsequently, meaning that they are mutually dependent. Okay, they are mutually dependent. So in that case, I will create a column for probability, create a column for cash flow, then expected value. This is P, this is X. All right. So probability of points. The first probability is 0.15. 0.15. The second one is 0.25. Is it? Yeah, 0.2, 0.3, 0.20, 0.3, 0.1, then 0.2. When
Zero
you, when you add up, the probability is
0.335.
supposed to be equal to 1.
0.35.
Which one?
The 0.3 is 0.35.
Okay,
Yes.
0.35. No, it can't be 0.35. 0.2, 0.35, okay. So when you add it up, supposed to be equal to 1, okay? So this is 1. All right. Therefore, I need to include the cash flows that we have computed. The first one is 12,000, 10,800, 9,000, 15,000, then 6,000. So to get the expected value, I need to multiply the probability with the cash flows. Okay? Let me complete my table first. All right. Then, of course, this is my expected value. So to get the expected value, 0.15 multiplied by 12,000 multiplied by
1/8.
that's 1/8.
The next one, 2160,
2160,
3150,
3150,
15,
15,
12,
12. When you add it up, you should have 98 10, 9,810, meaning that the expected value of the first year will be 9810, year two, 9810, up to year six is 9810. Now that the expected value is constant at 9810 because they are mutually dependent. Therefore, for me to now get my NPV, expected NPV, I will come here, year 1 to 6, cash flow equal to 9810. So is there any scrap value in the question? Yes, we have a scrap value. We are told that the equipment will be sold for 5,000 naira after the end of the project. So at year 6, there is a scrap value of 5,000 naira. So I need to calculate annuity factor of year 1 to 6 at 10%. Therefore, 1.1 raised to power 6 minus equal minus 1 equal divided by 0.1 equal. That's 4.355. Here is 4.355. So discount factor for year 6, 1.1 raised to power 6 minus equal 0.564. Okay, 0.564. So let's get the PV. 9810 multiplied by 4.355 equal 42,723. 42,723. Then 5,000 multiplied by
2820,
okay, 2,820. So I need to get my NPV. So NPV will then be equal to 5,000,
5543.
543. That's the expected NPV. That's how to calculate expected NPV. It's as straightforward as that. Now that I've calculated the expected NPV, number two requirement says you should calculate standard deviation. So let's go ahead and compute the standard deviation of the NPV. But first thing first, you can't just go ahead and calculate standard deviation of NPV. You need to first of all calculate the variance. After variance, you get the standard deviation, then you calculate the standard deviation of NPV. So for me to get variance, then I need to first of all deduct the expected value from the expected return from the required return, or expected cash flow from the required cash flow. So to do this, I will say x minus x bar square, then probability of x minus x bar square. So my x bar is 9810. So 12,000 minus 9810. 12,000,
2,190.
2,190. 2,190 square is what? Yep. 2,190 square.
479600.
479,600. Okay. 47. What's wrong with you? 479,600. Multiplied by probability of 0.15.
7,19415. 719,415.
719,415. Okay. Then the next one, 10,800 minus 9,810.
990.
990 square.
980,100.
980,100. Multiplied by 0.2 probability.
196,020.
196,020. The next one, 9,000 minus 9,810. Minus 810. Minus 810 square.
65600.
656,100. Multiplied by 0.35 probability.
229635.
229635. 15,000 minus 9810.
5190.
5190 square.
26,936,100.
26 million
93600.
Okay. Multiply by 0.1. That will be 2,693,610.
693 610.
Okay. So 6,000 minus 9810 minus 3810 minus 3810 square.
14,51600.
14
51600.
516 100.
100.
Okay. So multiply by 0.2.
29 2903
03
220.
2903
3 220.
2220. So add it up. Add it up.
Six
6,
seven
7.
four one
Okay.
41 900.
900. So that represents the variance. That is the variance. Now that I have the variance, I need to compute standard deviation. Remember, standard deviation, ordinary standard deviation is computed as the square root of the variance, which is summation of probability of x minus x bar square, which is equal to square root of 6,741,900. So this should give us what? That's 2,597. Am I correct? Confirm.
Yes,
Yes.
that's correct.
So now that I've computed ordinary standard deviation, I can then proceed to calculate the standard deviation of NPV. Therefore, standard deviation of expected net present value will be computed as the standard deviation multiplied by annuity factor. Remember, cash flows are mutually dependent. Because our cash flows are mutually dependent, that's why we are using this formula. Therefore, 2,597 multiplied by annuity factor of 4.355. So this will give you 11,310. Please confirm.
Confirmed.
All right then. So that is standard deviation. Finally, number 3, you have to compute coefficients of variation. Calculating coefficients of variation, CV. Okay, so the CV, because we have calculated standard deviation of NPV, therefore our CV will be equal to standard deviation of expected NPV over expected NPV, which is equal to 11,310 divided by 5,543. This will give us 2.04. Please confirm.
Confirmed.
All right then. So that's end of the question. That is end of the question. So look at it. Let me know if you have any question. If not, let's have another illustration for where you have independent cash flows. Okay. Let me stop sharing this and move to the notes. Okay. Yes, let's try illustration number 4. Because in this illustration number 4, each of the years have different cash flows. So that should be independent cash flows. So somebody should read illustration number 4, please. Okay.
Barcelona Limited has an investment proposal that has the following probability distribution of returns.
Okay.
The events of each year are independent of other years. The outlay on the project is fixed at 22,000 naira, and the appropriate discount rate figure is 10%. Required: calculate 1, the expected net present value; 2, the variance of return in each of the years; 3, the standard deviation of the net present value; 4, the coefficient of variation.
Yeah, thank you, Jide. Yes, that is the question. So you want to calculate expected NPV. You also asked to calculate the variance. So this is a very straightforward question. What am I supposed to do? In fact, let me stop sharing. Within the next 15 minutes, we'll be done. So that we move to sensitivity. Yeah. Okay. Solution to illustration 4. Barcelona limited. So the first requirement says you should calculate expected NPV. All right. So in this case, I can start with, I will say calculating expected value and variance, okay, for each year. So for year one, I'll create a column for probability. Year two, I have a column for return, sorry, second column for return. I will have expected value. Because I want to calculate variance, I need to extend x minus x bar square, then probability of x minus x bar square. So for year one, probability is 0.2.44, 0.2, 0.4, 0.4 equal to 1. Then the returns, 6,000, 8,000, 9,000. 6, 8, and then 9,000. Then to get expected value, 0.2 multiplied by 6,000. That's 1, 2. Okay, 3, 2, then 3, 6. When you add it up, that will give us 8,000. So the expected value for year one is 8,000. Then to get the variance in year one, 6,000 minus 8,000 will give us minus 2,000. Minus 2,000 square will give us 4 million. 4 million multiplied by probability of 0.2 will give us 800,000. Okay, so 8,000 minus 8,000 will be 0. 9,000 minus 8,000 will give us 1,000. 1,000 square is 1 million naira. 1 million multiplied by probability of 0.4 will give us 400,000. So 400 plus 800 will give us 1,000, 1.2 million. That's the variance for year one. I will do for year two. Probability, okay. The probability, let me just use P. The return, expected value, x minus x bar square, probability of x minus x bar square. So probability of year two, 0.5. 0.5 each, okay, equal to 1. 8,000, 12,000. 50% of 8,000 is 4,000. 50% of 12,000 is 6,000. Therefore, expected value for year two is 10,000 naira. To get the variance, 8,000 minus 10,000 minus 2,000. Minus 2,000 square is 4 million. 4 million multiplied by 0.5 will give us 2 million. 12,000 minus 10,000, 2,000. 2,000 squared is 4 million. Multiplied by 0.5 is 2 million. Then add it up. That's 4 million. For year two, variance of year two is 4 million naira. Okay, that's 4 million. Then year three, probability, return, expected value, x minus x bar So x minus x bar square, probability of x minus x bar square. The probability of year 3 is 0.3, 0.5, 0.2. 0.3, 0.5, then 0.2 equal to 1. The cash flow is 7,711.17. 711.17. So 30% of 7,000 will give us 2,1. 50% of 11,055. 20% of 17,034. When you add it up, the total expected value for year 3 will be equal to 11,000. Okay? So let's get the variance. 7,000 minus 11,000 will give us minus 4,000. Minus 4,000 squared is 16 million. 16 million multiplied by 0.3. That should be 4.8 million. Please confirm.
Confirmed.
Okay, so 11 minus 11, 0. 17 minus 11 will give us 6,000. 6,000 squared, 36 million. 36 multiplied by 0.2, 7.2 million. So to get the total variance, that would be 12 million. Variance is 12 million for year 3. So now that we have computed variance as well as a expected value for each year, so the first requirement says we should calculate expected NPV. So I would then say number 1, calculating expected net present value. So to do this, create a column for year, item, cash flow. The cost of capital according to the question is 10%. Then present value. Year 0, 1, 2, 3. There is no scrap value. So initial outlay according to the question is 22,000. 22,000. Cash flow for year 1 is 8,000. Year 2 is 10,000. Year 3 is 11,000. So that's the expected value we computed. Okay? 8,000, 10,000, and then 11,000. So with this, I can then say discount factor for year 1 is 0.909. At 10%, 826 for year 2, 751 for year 1. So multiply, give me the present value. This is 8260. This is 7510. What about year 1? That should be 8261. So add it up. Final answer.
So I got 7272
Which one?
Yeah.
for year 1.
Year 1.
Oh, sorry, error of mind. Yes, supposed to be 7272. So add it up. A minus 22,000. What you get?
$1,042.
1,000, no, it's not correct.
11,000 times 0.751 is 8261.
Oh,
1793.
thank you. So 8261. So 1793 is the expected NPV. So the expected NPV is 1793. Okay. Then number two requirements, we have to calculate variance. We've already done that. Number three, standard deviation of the NPV. Or if you can just say number two, variance, calculating variance. Okay, so create a column for year, then variance, year one, year two, year three. Variance of year one is 1.2 million. Year two is 4 million. Year three is 12 million. That's that. Then number three, requirements, standard deviation of NPV. You have to compute standard deviation of NPV. So calculating standard deviation of NPV. So with this, I need to ask myself, what kind of formulas am I going to use? The formula you are going to use will depend on the nature of the cash flows. This is independent cash flow. Therefore, the standard deviation of NPV will be computed as the variance in each year divided by 1 plus R raised to power 2t. Okay? The numerator represents the variance in each year. R is the company cost of capital of 10%, then T is the time period. Therefore, the variance in year one is 1.2 million divided by 1.1. Cost of capital is 10%. 1.1 raised to power 2 times year one plus variance of 4 million over 1.1 raised to power 2 times year 2 plus variance of 12 million divided by 1.1 raised to power 2 times year 3. Find the square root. Okay? Now, I can then say 1.2 million over 1.1 raised to power 2 will give me 1.21 plus 4 million divided by 1.1 raised to power 4 will give me 1.4641 plus 12 million divided by 1.1 raised to power 6 will give me 1.771561. Please confirm. Don't rely on my number. Always confirm. Is it correct?
Yes.
Okay, then thank you. So mathematically, I will use calculator to get the final answer. Therefore, bring out your calculator from your end. Let's do it together. So open a bracket. 1.2 million divided by 1.21, close the brackets, plus open another bracket. 4 million divided by 1.4641, close the brackets, plus open another bracket. 12 million divided by 1.771561. Close the bracket. Equal. Then press the square root. I got 3239.98. That's 3240. So 3240 is the final answer. So use your calculator. You should be able to get the same thing. So that's that. Then number 4. Coefficient of variation. Calculating coefficients of variation. CV. Remember, the CV is a function of standard deviation and expected value. So CV, because we have calculated expected MPV and the standard deviation of expected MPV. So this is the formula to use. The standard deviation of the expected MPV is 3240, while the standard deviation is 1793. This should give us 1.81. Please confirm. Is it correct? Are you still there?
Yes.
All
Yes,
right.
correct.
Okay, then. So that's end of. So far, we have discussed and calculated expected value, standard deviation, and coefficient of variation. So let's move on to sensitivity analysis. So if you don't have any question on the illustration we just solved, so I will stop sharing and move to the notes. Okay. So let's talk about sensitivity analysis. The sensitivity analysis measures the tolerable extent to which a project NPV can accommodate any change in variable. That is, what is the percentage change in variable before a project will become unviable? That is what sensitivity analysis measures, and it's also known as what-if analysis. Okay? Sensitivity analysis is also known as what-if analysis. I said, sensitivity analysis measures the tolerable extent to which a project NPV can accommodate any change in variables. Okay? Variables include cost of capital, initial outlay, sales value, sales volume, variable cost, contribution, incremental fixed cost, project life, savings, scrap value. It could be anything. All right. All of these are what is called variables. Variables are the components that make up the project being evaluated. Therefore, you want to know what is the percentage change in cost of capital before the project will become unviable? What if the sales volume reduced by 5%? Can the project still be viable? If we reduce the project life by 10%, can the project still be viable? This is what sensitivity analysis measures. That is, the tolerable extent, the percentage change in variables before the project will become unviable. So how do you then compute sensitivity margin? The sensitivity margin can be computed in 3 different ways, depending on the variable you want to compute for. So for all the variables, excluding the cost of capital and the project life, then sensitivity margin should be NPV over PV of the variables. When you want to compute for all the variables, apart from cost of capital and the project life, it should be the ratio of NPV to the PV of the variable. All right. So that's for that. Then You can also, if you have to compute sensitivity margin of cost of capital, it represents the internal rate of return minus cost of capital over cost of capital multiplied by 100%. Everything must be expressed in percentage. Then finally, if you have to compute sensitivity margin of project life, the sensitivity margin of project life represents the project life minus break-even point of project life over project life multiplied by 100 over 1. Okay? However, when you want to calculate sensitivity margin of project life, you are not going to be given the break-even point of project life. You are the one that will determine it. Therefore, how do you compute the how do you compute the break-even point of project life? So let me show you. Let me use this space to do that. Okay, calculating a break-even point of project life. Okay, how do you do this? There are 3 stages, there are 3 steps you are supposed to carry out. Number 1, step 1, so you reduce the life of the project by 1. For example, if the useful life of the, let me write it properly, instead of saying life, let me say useful life. So you reduce the useful life of the project by 1. If the useful life of the project is 5 years, you minus 1. So remain 4. Then step 2, compute NPV of the reduced life. Okay. Then step 3, calculate break-even point of project life using the formula below. Okay. So break-even point of project life will be calculated as the reduced life plus NPV of the reduced life divided by NPV of reduced life plus NPV of the normal life, just as if you want to calculate internal rate of return. In fact, break-even point of project life is internal rate of return. Okay? So multiply by normal life minus reduced life. That's it. This is the formula for calculating the break-even point of project life. Whenever you are asked to compute the break-even point of project life, these are the procedures you are expected to carry out. Okay? So that's that. That's that. At this point, we can then have illustration. Quickly, let's have illustration to their effect. Okay. Let's have illustration number 3. Illustration number 3, who will help us to read quickly? Yep. Let me look for somebody to read. I want to know those that have not been talking. Muriel, I've not heard your voice tonight. Talk to us. Can you read, please?
Okay, yes, sir. Tinapa PLC has sought your advice as a financial consultant on its investment proposal. It plans to diversify into the production of toilet soap. You are provided the following information relating to the proposal. The initial investment in plant and equipment will cost 4.8 million. The plants are expected to have a lifespan of 10 years with negligible scrap value. The company plans to maintain a minimum of 80% of installed capacity each year. At this activity level, 240,000 units are expected to be produced. The annual production overhead, excluding depreciation, is estimated at 360,000, while variable cost is planned at 18 naira per unit. The market research carried out favors setting the selling price at 24 naira per unit. The company's cost of capital is 17%. You are required to A. Advise whether the investment proposal is worthwhile. B. Calculate the tolerable level at which the following can vary without any adverse effects on the investment proposal. 1. Initial investment cost. 2. Production cost. 3. Sales price. 4. Sales volume. 5. Variable cost. 6. Production life. 7. Cost of capital.
Thank you very
Annuity
much.
formula.
Yeah.
All right. Thank you, sir.
Yeah, thank you very much, Muriel. That is the question. Now, in addition to the concept we just discussed under sensitivity margin, whenever you are asked to compute sensitivity margin of sales volume, you are expected to use the present value of contribution as the denominator. Okay, I repeat, whenever you are asked to compute sensitivity margin of sales volume, you are expected to use the PV, the present value of contribution, as the denominator. So in this particular requirement, you have to advise whether the investment proposal is worthwhile. That is, you want to calculate NPV. So let me stop sharing this and move to the working notes quickly. All right. Solution to illustration number 3. Okay. The name of the company is Tinapa Limited. Is it a limited or PLC? PLC. Tinapa PLC. Okay. Then we have to compute NPV. Number A, so calculating net present value. So create a column for year. According to the question, the cost of capital is 17%. Then the PV, year 0, initial investments. According to the question, the initial investment is 4.8 million. So our figures will be restricted to thousands, 1,000 naira. Multiply by 148. So the useful life of this project is 10 years. In the question, I can see selling price of 24 naira. I can see variable cost of 18 naira. It means I need to go ahead and compute contribution. So first thing first, let's go and compute contribution. So this will be for the NPV, the sensitivity margin, 2 pages. Then we have workings. Working number 1, calculating contribution. Contribution equal to selling price minus variable cost per unit. 24 naira minus 18 naira equal to 6 naira per unit. Okay, so total contribution would then be equal to, we are told that 240,000 units will be produced and sold, multiplied by a contribution of 6 naira. This will give us 1,440,000, okay, per annum. So since our contribution of 1,440,000 is constant, so for the next 10 years, so we then say year 1 to 10. Let me write it. Contribution, annual contribution, 1,440,000. Somebody should give me annuity factor of year 1 to 10 at 17%.
4.659.
Thank you.
Yeah, that is confirmed.
4.659. Okay. So 1,440 multiplied by 4.659. That's 6,709. Please confirm.
Confirmed.
Okay, then. So we also have production costs. We are given annual production costs of 360,000 naira. Examiner has told you that the annual production overhead, excluding depreciation, is estimated at 360. I've already told you, whenever you are given a fixed cost that excludes depreciation, that fixed cost is relevant. You have to account for it. So annual production cost, 360,000 multiplied by 4.659. What do you get? 1,000,006 what?
677.
Okay. Final answer. What's our NPV? NPV will be 232. That's our NPV. So examiner is asking you to advise whether the investment proposal is worthwhile. I would then say the investment proposal is worthwhile. Why? Considering the positive net present value of 232,000 naira. That's it. Number B, you have to compute. Look at that number B requirement. You have to calculate the tolerable level at which the following can vary without any adverse effect on the proposal, on the investment proposal. You can see, examiner did not ask you to calculate sensitivity margin, but it is implied in the question because examiner has mentioned tolerable level. Not only that, you're also given the variables. So you should know that you are supposed to calculate sensitivity margin. So I would then say calculating sensitivity margin. Okay, SM. Number 1, sensitivity margin of what's the first variable? Initial investment cost. So sensitivity margin of initial investments will be computed as the net present value divided by the present value of initial investment multiplied by 100/1 equal NPV is 232. The PV of initial investment is 4,800 multiplied by 100/1. So what you get? what you get? 232 divided by 48 equal multiply by 100. That's 4.8%. Here is 4.8%. Again, there's something I forgot to tell you. Each time you compute your sensitivity margin, you must interpret your results. You need to interpret your results. So there are two different ways you can interpret your results. If you want to calculate sensitivity margin of variables, including initial cost, initial outlay, cost of capital, variable cost, okay, incremental fixed costs. Your interpretation should be that the variable should not be allowed to increase beyond the percentage attained. Otherwise, the project will not be viable. So if you want to calculate sensitivity margin for other variables, including the sales volume, sales value, contribution, savings, scrap value, project life. The interpretation should be that the variable should not be allowed to fall below the percentage attained. If not, the project will not be viable. So those are the two different ways you can interpret your result. Based on what we just calculated for initial investments, I will do one under cash outflow, then we do one for under cash inflow. So with this, I need to interpret my result. I will then say the initial investments should not increase beyond 4.8%. Let me write that. 4.8%. If not, the proposal will not be accepted. The investment should not increase. I did not put not. Okay, so that's the interpretation. Now, in practice, this is what we are saying. If the initial investment of 4.8 million, if it increase, it can increase by additionally by 4.8%. The initial investment of 4.8 million naira can increase additionally by 4.8%. Anything above that 4.8%, the project will become unviable. It means that this 4.8% is what will make the project to break even. All right, that is what will make the project to break even. So if you increase the initial investment by 4.9%, the project will not be viable. It will be negative NPV. That's the implication. Next one. The next variable is production cost. So sensitivity margin of production cost will be equal to NPV of 232 is the same formula divided by the present value of production cost, which is 1677 multiplied by 100 over 1. So what do you get? 232 divided by 1677 equal
13.8%.
Thank you. 13.8%. So this will have the same interpretation as initial cost. So you need to say at all time, anytime you compute for sensitivity margin, all of them, you have to interpret your result. So I'm not going to put it down. So because of time. But in any case, just say the sensitivity margin, sorry, you just say the production cost should not increase beyond 13.8%. Otherwise, the project or the proposal will not be accepted. So number 3, sensitivity margin of sales price. Sensitivity margin of sales price So which is NPV of 232 divided by the PV of sales price. We don't know the PV of sales price, so we need to go and work it out. So working number 2, PV of sales price. Before you can get the PV of sales price, you need to first of all determine the sales price. The sales price will be number of units of 240,000 multiplied by the selling price of 24 naira. What do you have? 5 million
760.
760,000. So that represents the sales price. Now that I have the sales price, I can then determine the PV of sales price. So which is the sales price was 5,760,000 multiplied by annuity factor of year 1 to 10, which is 4.659. Give it to me. What do you have? 26 million.
835 840.
835,840. Remember, our figures are in thousands. Therefore, this will be 26,836. Okay? So let's go up there. 26,836 divided by 26,836 multiplied by 100 over 1. What do you get? Okay? That's 0.9%. That's 0.9. Okay? So I need to interpret this. I would then say the sales price should not fall below 0.9%. Otherwise, the investments proposal will not be viable. Okay, that's the interpretation. Number 4, you have to calculate sensitivity margin of sales volume. Sensitivity margin of sales volume. Remember, whenever you are asked to compute sensitivity margin of sales volume, the PV of contribution should be used as the denominator. Therefore, 232 divided by 6709 multiplied by 100 over 1. So give it to me. 232 divided by 6709. That's
3.5%.
3.5%. Thank you. Again, these have the same interpretation as the sales price. That is, the sales volume should not fall below 3.5%. If not, the project will not be accepted. All right, you can reduce the sales volume of 240,000 units. You can reduce it by 3.5%. Anything below, if you reduce it by 3%, then the project will not be viable. All right, you should not reduce below 3.5%. Okay. All right, then. Number 5, sensitivity margin of variable cost. Sensitivity margin of variable cost, which is NPV of 232 divided by the PV of variable cost. We don't have it, so let's go and compute it. Working number 3, PV of variable cost. So variable cost first, total variable cost will be equal to the number of units of 240,000 multiplied by variable cost per unit of 18 naira. So what do you have? 4320. Okay, so that's the total variable cost. Therefore, the PV of variable cost will then be equal to 4320 multiplied by 4.659. What do you have here? 20 million, 125 watts. Yep. Okay.
Okay, I got 20,126,880.
Okay. 880,
126,880.
880. So since our numbers are in thousands, that will be 20,127. 20,127 divided by 20,127 multiplied by 100 over 1. Give it to me. 232.
1.2%.
1.2%. Thank you. Again, the variable cost should not increase beyond 1.2%. If not, the project will not be accepted. Number 6, sensitivity margin of product life. Okay, which is product life minus the break-even point of product life divided by the product life multiplied by 100 over 1. We know the product life to be equal to 10 years, but we don't know the break-even point of product life. So let's go and compute the break-even point of the product life. Working number, that will take us to working number 4. Calculating break-even point of product life. Okay. So there are 3 stages, 3 procedures. The first procedure is to reduce the life of the project by 1. The life of this project is 10 years. 10 minus 1, 9 years. Then you now compute NPV for 10 years. All right. Then thereafter, you calculate the break-even point of product life. So create a column, description of items, cash flows, discount factor at 17%. A wise student will go ahead and compute annuity factor of year 1 to 9 at 17%, so that before I ask you, you give me the numbers. Okay, initial investments of 4,800. Here is 1. Okay, 1 multiplied by that to give us 4,800. Year 1 to 9, contribution 1,440. Annuity factor of year 1 to 9, what do you get?
4.451.
4.451. Thank you. 4.451. So give me the present value. Present value 6.
Um, 6409.
2.
64094.
Okay, 09. Okay, 1 what?
1602.
1602. Final answer. What's your NPV? That should be 7. NPV is 7. Therefore, step 3 says you should calculate the break-even point of product life, which is reduced life plus the NPV of the reduced life over NPV of reduced life plus NPV of the normal life. Okay, we are calculating internal rate of return. Normal life minus reduced life. That's it. So equal. We have reduced the life of the project to 9 years plus NPV of that 9 years is 7. 7 plus NPV of normal life, 232. Okay, normal life is 10 years minus reduced life of 9 years. So this will give us 9.03 years. Okay, so the break-even point of the product life is 9.3 years. So I will then go up there to say minus 9.3 divided by 10 multiplied by 100 over 1. This should produce 9.7%. Please confirm. Is it 9.7%?
Confirmed.
All right then. So which means that the project life should not reduce below 9.7%. If not, the project will not be accepted. The last one, number 7, sensitivity margin of cost of capital. Okay, which is equal to internal rate of return minus cost of capital divided by cost of capital multiplied by 100 over 1. Because in this formula, we have internal rate of return. So it means we need to go and calculate internal rate of return. So I will go to the next working. That should be working number 5. I want to calculate internal rate of return. Calculating IRR. How do I do this? So I need to assume discount rates. So let's assume when you look at the NPV we computed, the company cost of capital is 17%, and we computed NPV, we got 232,000. So let's assume 20% and see if 20% is positive, then we increase the discount rate. But if it is negative, then we are going to assume 70% as the second discount rate. So let's assume 20% first. So here, item, cash flow, discount factor at 20%, then the present value. Year 0, initial investment, 4,800. 1, 4,800. Year 1 to 10, contribution. Somebody should give me annuity factor of year 1 to 10 at 20%.
4.192.
4.192. Thank you. So year 1 to 10, production cost 360 multiplied by 4.192. Give it to me. The PV
6036.
6036. Then
1509.
1509. So 6036 minus the rest. Yes. Final answer.
272 negative.
272 negative. Thank you. Okay. So at this point, the next thing I need to do now is to compute my internal rate of return. So in that case, that means we assume 17% and we go to 32, we increase to 20%, we get a negative 272. Therefore, internal rate of return. Pardon?
I said, I think it's 273, not 272.
273, okay. So, all right, so 17% is lower, plus NPV of the 17 is 232, divided by 232, plus NPV of the higher, which is 273. So higher of 20 minus lower of 17. Final answer. So 232 divided by 505 equal, multiplied by 3 equal, plus 17 equal. This should give us 18.38%. Please confirm.
Confirmed.
All right then. So
Sorry, are we adding the 273 or we are subtracting?
it's adding. Minus times minus will give you positive. All right. The original formula is NPV of A divided by NPV of A minus NPV of B. NPV of B is always minus. Therefore, minus times minus will turn to positive. So there is no need to put minus there again. All right. Okay. So I will then come here 18.38 minus 17% divided by 17% multiplied by 100 over 1. Final answer, what you get? Yep,
8.1%.
8.1%, which means that the cost of capital should not increase beyond 8.1%. If not, the project will not be accepted. So that's it. That's end of the question. That's end of the question. That is how to compute sensitivity margin. That's how to compute sensitivity margin. Let me know if you have any question for me before we close the class. One of you has disappeared. Who is that person? One of you have disappeared. Who is it? Who is he or she? No worry. No worry. That should be Jide. That's Jide. Jide has disappeared. All right then. So let me know if you have any question for me. Other than that, that will be the end of the class for today. We'll meet again next week by the grace of God. Good night, everyone.
Yeah,
Thank
good
you, sir.
night.
Good night.